On March 4th, 2025, the government enforced a 25% tariff on imports from Canada and Mexico, alongside an increase from 10% to 20% on Chinese goods. These measures aim to increase government revenue from these countries. Tariffs are taxes on goods, which could increase costs for consumers, along with retirement accounts invested in domestic, international stocks, bonds, and mutual funds. For example, there's going to be an increase in taxes on metals like steel and aluminum from Canada or Mexico, which is where the majority of our car parts are made. The cost of buying a car could obviously increase if the temporary reprieve ends without an extension. This also impacts investors in the companies and future investment from that company. For example, if I am doing business internationally, and I'm not, I would absolutely put a pause on further development overseas until I understand how the tariffs are going to pan out. This may also impact future hiring. I'm obviously not going to staff the offices or manufacturing plants that I have on hold. This is a concern that could lead into a possible recession. Now, that's the bad news. What's the good news? I heard a reporter recently on Bloomberg say that Donald Trump treats the stock market like his daily report card. I tend to agree with that analysis. I don't think this will negatively impact stocks long term. There will be some form of correction. How does this impact you? Remember, when we set up your accounts, we're not putting everything into one bucket. Not everything is individual stocks, not everything is mutual funds, not everything is mutual funds and bonds and stocks. We have three distinct buckets. You have a part of your bucket that is typically that safety net. Money market funds, a lot of times index annuities, where when the market crashes, you don't lose a dime as a result of the stock market dropping. That's very important. That is our safety net. That's our correction there. But on top of that, the structured notes that we do that are held at Charles Schwab, that are typically, we'll say National Bank of Canada, Barclays, BNP Paribas, I probably didn't say that right. But those structured notes are there to generate income even if the market takes a 10, 20, 25, 28% downturn. So we're still very much in that world where, yes, the market has gone down this year. No, that has not affected the income that we're generating over the long term. The part most affected right now is the growth bucket. And the reality is that in the majority of our portfolios, we haven't seen that big of a correction, not by our terms. And the whole point of that growth bucket is so that we do not have to be reliant on it in the short term. We have the income and we have the safety net bucket there so that we don't have to worry about this stuff. So this is a reminder that we plan not because we can predict the future, but because we know events like this can and will happen and will continue to happen again. And our goal is to keep you prepared for them like we already have. You're welcome. If you have questions, feel free to reach out. But if you look at your portfolio and you look at the transactions, you'll see on Schwab that even though the market value has declined, because it would, obviously, we're not going to be able to sell those notes for what we bought them for if we were to sell them. We expect to get every dollar back. But you'll see that we're still generating the exact same amount of income that we were the previous month. Let that be comfort to you, because we're going to continue to do that over time. Thank you. Thank you for watching. If you'd like to schedule a 15-minute phone call, go ahead and click the link in the description below, and we look forward to talking to you soon.